In this video, we dive into the Fed, okay? Now, in the United States, the Fed is our central bank. Technically, its name is actually the Federal Reserve Bank, okay? But we just affectionately call it the Fed, okay? So in Europe, this would actually, the same entity in Europe would be the European Central Bank, or the ECB. Basically operates in the same way as the Fed that we're going to discuss kind of in this video, and then their operations in the subsequent videos, okay? Now, for us in the United States, it was created in 1913, right? So well before the start of World War I, okay? The idea is it serves several roles. It's a lender of last resort for banks. That is, when banks are having hard or fall on tough times, the Fed is supposed to step in and help them, right? Now, this is actually where the Fed kind of fell down during the Great Depression, right? The Fed did not do a very good job during the Great Depression. The Fed was pretty bad because it was supposed to serve as a lender of last resort, and it didn't with a lot of the banks. There were a lot of bank failures during the Great Depression, right? But it is supposed to serve that role. And we'll talk about one of the tools where it serves this role, right? And as it's going on right now with the coronavirus, the Fed is actually serving this purpose, right? It's created a bunch of different ways that banks can take out loans to help them deal with the growing defaults of small business loans, okay? Now, in addition to being lender of last resort, they also manage the money supply. And this is what we'll spend most of the subsequent videos on, is what we call monetary policy, okay? But, oh, not one. I already have one up there. This is two. So they manage or control the money supply through monetary policy. And the last aspect is they regulate the banks. They are the regulators of the banks. So if banks start to goof off and do nefarious things, the Fed is the entity that is supposed to step in. So, for example, when Wells Fargo created a bunch of bogus accounts for a lot of its account holders to kind of inflate sales numbers, they got in trouble. And it was the Fed that punished them, okay? So the current head of the Fed is a fellow named Jerome Powell. His previous successor was Janet Yellen. She's now, I think, out at professor out at Berkeley. Usually the head of the Fed is some nerdy econ type who ends up going back to a professor job. Jerome Powell is actually one of the first Fed presidents in a very long time who actually was not a university professor. So, okay, so that is the Fed. It's basically a government-created entity to oversee the banks and the monetary system here in the United States. Okay, so here's how here's the structure of the Fed. Okay, they have two entities. They have a board of governors, okay? And they also have what's called the Federal Open Market Committee, okay? Now, the Fed for the U.S. is in D.C. It's in Washington, D.C. Washington, D.C., okay? In addition to the main central bank in Washington, D.C., they also have 12 regional federal banks, okay? One of which is in Atlanta, St. Louis, Minneapolis, Boston, New York, San Francisco, Kansas City, and I'm forgetting the last few, right? But they basically have these regional Fed banks, okay? So there are 7 members on this board of governors, and they're all appointed by the president. And actually, I think as it stands today, there's a vacancy or 2 on this board. So it takes time for them to get appointed and then approved by Congress and so forth. But the chairman, Jerome Powell, is basically the chair of this board. So Jerome Powell is chair of the board. Okay. Now, the Fed also has another entity, and this is the entity that controls the money supply. This is called the Federal Open Market Committee. We just use FOMC for short because Federal Open Market Committee is a lot to write, okay? But this is the entity that controls money supply. Okay? Now, the FOMC, the Federal Open Market Committee, has a 12-member board. It includes the 7 members from the Board of Governors up here, okay? But then they add in 5 from the 12 regional presidents of the regional Fed banks, okay? And they rotate them. The only one that does not rotate, New York Fed does not rotate. The president of the New York Fed is always on the Federal Open Market Committee. And that's because actually the New York, again, it's New York. It's the, one of the key financial centers of the world, right? And the New York Fed actually was, long ago, did used to be kind of the main Fed bank. The DC Fed did not exist until 1913, but the New York Fed existed before that. So the New York Fed has always been a very, very important key bank in the United States monetary system, which is why the New York Fed is the one anomaly, and their position doesn't rotate off this board. But the key point here is that the Federal Open Market Committee is the committee that's in charge of managing the money supply. That is, controlling how much money is out there in circulation, okay? Now, the Fed and the European Central Bank and the Central Bank of Canada, all these central banks were created to have independence. So the idea is central bank independence, because you want to prevent people in government from influencing money supply. So this is what happened in the United States in the 1970s, right? Some presidents started to figure out that if there was a mild amount of inflation before an election, it would appear as if the economy was doing really well, and therefore the incumbent candidate was more likely to be elected, okay? So Richard Nixon was a very big fan of the Fed printing a lot of money before the election, and he leaned on Arthur Burns, who actually was the Fed chairman at the time. And so what happened was that in the 1970s in the United States, we started to get a rising amount of inflation, right? Inflation actually got up to around 10 to 14% during the 1970s. So it wasn't until Paul Volcker became head of the Fed that was brought under control in the late 1970s and early 1980s, right? So the United States had about a 15-year period there where the Fed was being influenced by the president and various politicians. So what was created was independence. That is, the Fed in the United States is an entity that is created by Congress. So for Europe, this would be an entity created by a European Parliament, right? But it operates independently. In the United States, the U.S. president can only appoint the head of the Fed. Once that head of the Fed is appointed, the president has no more power over him. Right? The idea is you want your central bank not to be influenced by politicians, okay? So this is what we call central bank independence. In general, what we found is when central banks are independent, they tend not to cause inflation, hyperinflation, or deflation, right? They tend to run the central bank in a more neutral fashion, okay? So now, what we're going to go on and discuss in subsequent videos are the 4 tools the Fed uses to kind of manage and control this money supply, okay? So let's kind of list them briefly, and then the next videos we'll kind of dive into them, okay? So the 4 tools of the Fed, so 4 tools Fed uses to control the money supply. Now, again, this is going to be for the United States, right? These tools are similar to what the European Central Bank does, okay? So the first tool and the most important one, and that's the one we're going to discuss first in the next video, is what we call open market operations, okay? And we'll kind of dive into what that is. The second tool is extensions of loans by the Fed. Extension of loans by, no, by is not spelled with an F, by the Fed. Okay? Now, this is basically the Fed acting as a lender of last resort. So when the Fed basically intervenes and is there to help out banks, it does this by making loans to them. Okay? The third tool is actually one we've already talked about, and that is reserve requirements. Reserve requirements. Let me actually make this lowercase. Reserve requirement. That 10% reserve requirement we used in previous videos talking about fractional reserve banking, that is set by the Fed. That is set by the U.S. Central Bank. Okay? And it turns out they could adjust that reserve requirement and, not surprisingly, adjust the amount of money that's in the monetary system because of fractional reserve banking. If you change that reserve requirement, you change the money multiplier, and therefore you change the amount of money that's in the system. Okay? And the last tool is actually a new one that was created basically at the end of 2008. Okay? And that is the Fed now pays interest on required and excess reserves. Okay? Interest on, but again, we're really going to talk about excess reserves, but interest on excess reserves. Okay, so these are the 4 tools the Fed uses, and we will dive into them in the next video.